The broadcast is now starting. All attendees are in listen-only mode.
Hello, this is Andrew from Trend Following Mentor, and this is part of our series with forex, where we're going to discuss about trading psychology, trading without fear. And this is one of the most important discussions that I think you'll hear, and my goal is to give you some interesting ideas that you will apply to your own trading. Before we begin, again, this is forex, and this is my website, Trend Following Mentor. My name is Andrew Abraham. What I'm going to do is, before we start, I'm going to start with a disclaimer, which will be right here. Just take a minute or two to read through it. And I also want to add that trading is not for everyone, and you have to make sure you understand the risks. And this is what we're going to be talking about, is how to identify and take trades and trade without fear. I am a professional money manager. I've been trading for 18 years. I trade every day. Been trading since 1994. I'm also an author. I have a book coming out called The Bible of Trend Following, How Professional Traders Compound Money and Manage the Risks. It'll be out in the beginning of December. I invite you to pick it up. And some of those issues that are what we're going to discuss are going to be discussed in the book as well. There's chapters on psychology and trading psychology, which, again, I feel are a paramount issue for your trading success. In the series, we talked last week about setup patterns. Basically, there's three concepts in order for your success. You need to have a methodology, which we discussed, and I'll show some of those also, some of these setup patterns that are low risk and fortunes can be made. But again, you need to be very cognizant of the risks. But even more importantly is the trading psychology. What do I mean by the trading psychology? The trading psychology is really the premise of all successful trading. Because regardless of any methodology that you trade or any pattern or anything you do, it all boils down to pulling the trigger. And what I've seen repeatedly is you have people that will analyze, and then they might talk to one of their colleagues or friends, and then they don't pull the trigger. What you need to do is be your own independent trader. You don't want to listen to anyone. You don't want to take advice. You're not looking for tips. You want to be independent. You want to trade without fear. The principle of trading without fear boils down to having a trading plan. A trading plan tells you exactly what you're going to buy or sell. And again, what we discussed in our prior week's discussion, I use a very simple methodology. It's a rate of change. I look to identify the strongest markets, and I look to sell the weakest markets if I can put on a low-risk bet. A low-risk bet is when you're risking a small percentage of your account size on any particular trade. What that means is, hypothetically, you have a $50,000 account size, let's say, and you want to risk 1% on the account. You only want to risk $500 on the trade. If it's a $100,000 account size, then you want to risk $1,000. This is the idea of a low-risk bet. And that also correlates to our idea of trading without fear. Once you've identified what your risk is, and you know what you're willing to risk on the table, then there shouldn't be any fear. You have to actually accept the risk. There is nothing to fear, but you accept it. But basically, going back to our idea, there's only four things that can happen too when you're trading. And I know it sounds repetitious to some that have seen my other lectures, but these are really the ideas that you need to come to terms with. There's only four possibilities: a big loss, a small profit, big profit. Your goal is to have and to control your losses. What that means is having a stop in the market immediately placed. There's nothing to think about. You know where you get in. You know what you get out. That goes to the second point that I said before. You know what you're trading. You're putting on a low-risk bet. You know where the trade doesn't work. You've accepted the risk, and you put on that trade without thinking, without guessing. There's nothing to worry. You've already delineated it. And if you can't lose $500 or $1,000 on a trade, or you're not willing to accept that risk, you just don't put on the trade. It's that simple. This is what I'm talking about, trading without fear. You have to accept the risk. The other thing, going back to those four principles, if you avoid the big losses, what's going to happen in your real-time trading, and also what I delineate in my book, is you're going to see, most of the time, you're going to have a lot of small losses and a lot of small profits. That's it. And then what you're going to happen is you're going to stumble into some big winning trades. You make yourself available for these winning trades. You didn't do anything special. You follow the same plan. You have a trading plan. And again, write this down. If you don't have a trading plan, then you shouldn't even be trading. Because if you don't have the plan, then basically you'll be trading with fear. So let's go to this point. I want to show you just some quick charts and then discuss the idea about trading fear. One second. Let me see if I can move this. One second. Here we go. I'm going to show you trades that are happening actually right now. And the idea of saying about accepting the fear. Here's a trade with the E-minis that you can see. And what's very interesting is that you can look at the prior day's high right here, which I've marked, and the prior day's low. Basically, this is a pattern. This is the high, and then you can see with the moving averages, and then you can also see with the MACD that basically we're not being able to take out these highs. So this is a trade that basically you can put on a low-risk bet and accept the risk. Basically, you'd be selling at this point right here, and the high is right here. So anyway, this is the point of a low-risk bet. So on this trade, you're basically risking from around 1378 to a high of 1385. That's your trading E-minis. I don't know if this trade's going to work. I've accepted the risk. I couldn't care less if it works or doesn't work. All I have to do is keep my risks small. Let's jump to another one with currencies, because this is what we do, is we talk about currencies. One second, let me move this. Let it load. One second. Okay, here we go. This is Swiss franc. Let's go to, actually I'm going to show you a trade that I'm looking at right now. Here's an interesting trade. This is actually the Aussie dollar, where you have the highs marked from the prior day. What's happening here, this is a pattern. You hit a high, hit another high, and now this high looks like it's failing. Again, I don't know if this trade is going to work. There's no secret sauce here, but all I'm doing is I'm listening to the tone of the market. The fact is the market wasn't able to take out these prior day's highs. So at this point, once it starts closing below the moving average, and you can see the MACD going down, you have a low-risk bet again. Basically, it was about 1370-ish you could go short, and you're risking to the highs here, which is 14,104, let's say, and I would put a couple ticks above it, maybe 14,104.13. This is an idea of accepting the risk. Not that you know if the trade is going to work. There are no magic patterns. What you're doing is you're working the psychology opposite of what the masses do. At this point, you have a high here. The high is failing. You have a pattern. You have a high, and then another high that's slowing down. It's falling below the moving averages, and the MACD is falling. So you're saying, let's put on a low-risk bet. Let's see what happens. Accept the risk. There is nothing to fear. You've delineated what your risk is from here to here, and then you're waiting to see what happens. Let the market tell you what's happening. Let's jump to another example. Canadian dollar. There's another perfect example. And again, you have to also watch your correlations when you're trading, that you're not correlated to too many other markets at the same time. What you had yesterday, this was a high from yesterday at the highs, where at this point, and we don't know if it's going to happen or not happen, but it cannot take out this prior high. What's happening again? You have a high, have another attempted high, and a failure. So all these people that bought in here and thought this was going to keep on going, they could probably be disappointed that the market is starting to fall apart on them. Possibly. The idea is like this. Again, to reiterate, you have a high, and it's failing. You're closing below a moving average. And again, you can use any moving average. I mean, I put on basically 2 moving averages. And some of your best trades are when the moving averages tighten up. The fact is like this. You have a low here, You want to take out this resistance here, or support, and right here, you might have put on a trade. And again, it doesn't have to work. This is what the idea is. A failure from the highs, a failure from the lows, where the crowds are wrong, and you look for a divergence in the momentum. Let's go back, and we want to talk about the psychology. The psychology really boils down to, again, you have a trading plan. You know exactly what you're buying. You know exactly what you're selling. You have to do your homework. You're not just jumping into a trade because you feel like it or you heard something. And then once you've put the whole package together, where you know what you're going to buy, what you're going to sell, what you're risking, and accepting that risk, and accepting yourself, then you trade without fear. This is the most important issue when you trade. Because I'm going to tell you what happens to me in my trading. There's going to be times, like I'll give you an example, yesterday. Yesterday was a very, very difficult period for me. I had just trade after trade after trade after trade not work. And even watch the words I'm saying. The trade not work. It isn't like I lost money, I was stupid, or any of these things. Trades either work or they don't work. What you have to realize is that every trade is 50-50. That there's no idea that you have to buy into the idea of a high win ratio. Because what's going to happen again with those 4 possibilities that I said before, that your biggest job is you have to avoid the big losses. The big losses are what's going to destroy you emotionally and financially. But again, when you're trading with this plan, you avoid it, and you're avoiding the fear. But you have to keep on putting them on. This really becomes the biggest issue, because you're going to have trade after trade after trade at times that just don't work. And that's okay. You have to accept the risk and accept the fact that because you put on a trade, it's fine. This is what really successful trading really boils down to. Let's see if there's any questions at this point. If you guys have any questions, let me just see if you have questions, and then I'll keep on moving forward. Okay. There's no questions at this point. Okay. Many other issues of the trading psychology I started to allude to. And the problem is people look for trading robots, they look for advice, they look for all of these things. The fact is like this. The answer is inside of you. You trade with a plan. You learn a methodology. And you follow that methodology. And then you accept that methodology. And then you're going to be fine. As long as you just be doing the same thing over and over and over again. And let the odds work for you. What is the idea here? The word becomes consistent. You need to be consistent when you're trading. You do the same thing over and over and over again. This is what I do. I look for patterns. Let's jump into over here again. I look for patterns. I look where the crowds are going to be wrong. I'm playing on their emotions. And you know what? And if this trade doesn't work, it's a very small percentage of my account size, and it doesn't faze me. It doesn't bother me whatsoever. So here, this is the Canadian, and let's jump to over here, the Australian. This one's looking a little bit better, but again, you just don't know. I'm going to go to another pattern. This is what we spoke about the other day. You have a low, and then a lower low here, which was the low of the day. If you got to think about it, what's happening here? The psychology was that everyone was thinking that this trade is going to keep on going down and down and down. And they were pretty much shocked at this point where it started turning up. So what is a trade here? What's a trade setup? You have a low, and you have a lower low here, but you close above. You take out the lowest point, and then you close above. And then what you really want to do is you want to put on a trade buying the close of that bar, and then you're risking, you would be risking from here, from the close, which was at 102.98, down to the low of this bar, 102.63. That's not a big risk. And then what's also happening here, which I want to point out to you, watch this MACD. The MACD is increasing. So that means who's in control here? Are the bulls in control or are the bears in control? Who's wrong? Who's right? And you know what? It's not the fact about being right or wrong. It's the idea of going and listening to what the market's telling you. And you know what? Make it another simple way. Watch this trend line. Right here. You broke out of that trend line. It's another confirmation. You're above the moving average here. You have every reason to go long this trade. And this was a nice one. And look, here you go. And now possibly we retrace and we're going down again. But the reason I took this, you say hearts off. Okay. One second. Bear with me 1 minute, please. Let's look at some other trades. So we're not accepting fear as an option. Let's jump to here. Let's do the euro dollar. That's another example. What you notice on the chart is I highlight the highs and the lows of every day. This is the high, this is the low. High, low, high, low. Where we are today, this is pretty interesting. And this is actually happening live, and this is the euro dollar. We have a high, another high. Well, look what's happening. It cannot take out that high. And if that high fails, again, if we're going to start closing below this 127.96, pretty good chance that the euro dollar might turn down. And again, look at the momentum here. The momentum is negative. So you're playing on the psychology. Okay, let's shift a little bit. I want to show another one here. This was a nice example here again. This was the lowest low here. And at this point, you had a divergence again. At this point, you were going down. Divergence starts showing. It starts showing that the bulls are coming into control. You had a big test, pullback. What a great point to be getting long here. You had a failure on the lows, and then the bulls were taking control. This is what good trading is. That you identify what the market is telling you. Forget about opinions. Your opinion, my opinion. No one's opinion means anything, because all we're really doing is we're listening to what the market is showing us. Okay? Are there any questions at this point? Okay. Very good. So let's go back again. I'm going to sound repetitious because I really want it to sink in. You trade with a plan. You trade with, basically, you identify the strongest markets and the weakest markets. And the way I do that is, and I showed this last week in Metastop, you do a rate of change. And I discussed that at length in my book about how to identify the strongest and the weakest markets. Then what you do is you look where the crowd is going to be wrong. Who's in control? The bulls, the bears, where are people going to be disappointed? And what you want to do is you want to be able to basically ride them. So let's look at another chart. To think of what I did yesterday. Let's see. Yeah, let's do another one here. 1 second. Let me move this. Okay, the metals. And this works on all time frames. And by the way, I'm doing 60-minute charts. And you can do hourly chart. I'm sorry, you can do daily charts. You can do 30-minute charts. You can do 10-minute charts. It's all the same. What you're looking for is you're looking to identify where the crowd is wrong. This is a gold. This is a pretty big move. As you can see, you had a massive low here. You look for key reference points, lows and highs and daily lows. And look what's happening. First, I'm going to point out what happened the other day on Friday, and then I'm going to point out what's happening exactly right now. You had this big, huge down bar. Then you try taking out the lows again. But what's happening to the momentum? You have a divergence again. The divergence is picking up. So what you're doing is look at the low here, and you want to have a close above this bar. And even more so, you would feel a little bit more comfortable having a close above this moving average, which you had here. So you're risking from, actually, what was this? Let's say 1711 down to a low of 1704, and you put a couple ticks below it. Again, you're not talking big risk. And then look what happens here. This was a huge profit. Now let's examine exactly what's happening today. You have a high, prior day's high from yesterday. And it's struggling with all of these bars to take it out. In the meantime, you don't do anything. You want to see a close below the moving average, preferably both. But because you had this big move up, this moving average is lagging now. Well, what's happening here? Look at what's happening. You're starting to see a weakness in the MACD, a divergence. So this possibly could be a trade. You have a high. Try taking out the high again. look where it ended. It failed at the lows. That's definitely not positive for, let's say, for the bulls and all these people that wanted to go long here. So again, this gives you an opportunity possibly to go short. And this is just a pattern. You have a high, a failed high, and especially at a key reference point, which were the prior day's highs. And what's also confirming, and you can look back at this chart in a couple hours, because, I mean, this is a live chart of gold, that you're having a divergence and you're starting to see some negativity here. This is really what we want to stop doing. We want to try to identify these key points and be able to go short. Again, let's go back if there's questions or anyone has any points at this point. I just want to make sure I'm not going too quick for anyone. Hang on, let me just make sure I can see if there's questions. 1 second. Hold on. Let's just see. Any questions? I don't see what my questions thing went to. Hold on 1 second. Bear with me. View. Control panel layout. Let's see what happens here. Nope, I don't see there's any questions at this point. So anyway, let's keep on going. What does it mean, trading without fear? What the idea is, again, you have a trading plan. Each and every one of us has their own trading plan, because this trading plan has to be applicable to your personality. The other idea that I brought out before is risk per trade. What I suggest is you don't want to risk more than 1% of your account on any one trade. What does that mean? Again, if you have a $50,000 account, you want to risk $500. But let's say you want to take a bigger risk. You know what? You're allowed. You set the rules when you make your trading plan. Because the whole idea, again, to reiterate, is when you have this trading plan, that you know what you're doing at all times. You know what you're buying or selling. You know what gets you into a trade, and you know what gets you out of a trade. You have to make those rules up in order to be consistent. Because that is really what our goal is that we want to be consistent in our trading. But the fact is, there's going to be people that they're going to say, 1% risk is too much. I'm sorry, too little. And they're going to want to risk 2 or 3% of their account size. Let me bring you out to this point. And I always like making the analogy. Risk per trade is like bites out of an apple. A bite out of the apple is the fact that if you're risking 1% of your account size, you can have 100 bites, or 100 times the trades can't work. If you're risking 2% of your account size, it means 50 times the trades don't work, and you're out of business. You're doing 3% risk per trade, that means 33 times. Again, in the real world, you will go through periods like I had yesterday, which was absolutely ugly. Trade after trade after trade didn't work. But you know what? They were small losses. It didn't faze me. I didn't trade with fear. I didn't trade with greed. I have an exact plan. And this is kind of what the whole idea is, that you develop this plan and you're consistent following it. So you need to ask yourself, how much are you willing to risk on a trade? And it's almost, imagine that right now I'm sitting actually with my wife, and my wife's having a eye operation, that on top of this tall building. Imagine you stand on top of a tall building and you have $100 bills in your hand. You have 500 of them, you have 1,000 of them, 3,000 of them. Imagine going to the roof and just throwing this money off the roof, off the top. This is what the whole idea is. You have to be able to accept the risk. If you don't accept the risk, then you shouldn't be trading. That's why the idea interrelates, or I guess the best word is interrelated to your risk per trade. Because I'm very comfortable risking anywhere between 0.5% to a maximum of 1.25% on any trade. I have 3 models that I trade for a living on. One of them is basically, it's almost the analogy of trying to do a fixed income type of trading where I don't have a lot of volatility. You know what my goal is? It's going to be shocking. My goal is to make 10%. That's it. But not to have big losses and big drawdowns. Because then this way I can manage a lot of money. The other model I trade, and I call it Formula 72 because it's the whole idea of compounding money, that I'm looking for bigger returns, and I know I'm going to have bigger risks. A lot of people have the false conception that this is a get-rich-quick. It's not. It's a grind it out. It's being consistent. My goal in that model is 15%. And I know, because I've been trading since 1994, that my drawdowns have been in the mid-20% range. And I accept it. And when they happen, it's not comfortable, it's not fun, but I still take them. And just whatever, you don't have a problem. So anyway, the other model I have, it's a high volatility model, high volatile, where I look for big returns and I'm going to have big drawdowns. I'm looking for something in the mid-20s to 30% return over the year. And historically, I've had close to 40% drawdowns, which is ugly. I'm not phased. I don't quit. That brings to this point also. The idea is it's very, very easy to quit. Many people get started and then stop. The reason they do that is because they don't have this trading plan in place. It's like a business plan. At every moment, you know what you should be doing. This is the whole concept of trend following. We're trend following. We're listening to what the market is telling us what it's doing. Not that we're deciding. Our opinions mean nothing. So going back, idea is like this. You can trade without fear because you've already decided what you're willing to risk on a trade. And you're trading with a complete trading plan that at every moment you know what you're doing, you have a complete concept, and again, it can be any of these markets. Like what I'm looking at live, like I showed you, I had gold here. I can have the grains. It's all the same. All the currencies are the same. None of it matters. Here, let's do just a grains. Okay, this is a corn. Nothing's really happening here. You can look at it. I'm trying to move over this. There we go. Basically, we're at the highs and chopping around, nothing happening. But what's interesting is the momentum starting to diminish. Maybe this trade will, fall out of bed. This one's interesting, actually. Soybeans. We had this big down move. Now you're chopping around. But again, why did you have this big move up? You have a low, a lower low, and you closed up. Momentum is increasing. You buy the high of this bar once it closes above the moving average, right about here, and you're risking down to here. Very simple concepts. Again, to reiterate, you're identifying the prior day's lows, the prior day highs, and then you're trying to listen to the tone of the market without any opinions. And where's the people going to be wrong? This was a counter trend. Let's see another one here. Here's another one, basically. Low, lower low, closed up, momentum's increasing. Here, you go from here, you're risking from, this is soybeans, you're risking from 14.10 down to 13.91. Not that big of a risk. And a nice move up. And then you started plateauing here. What's the market telling you? Look what's happening to the momentum. Starting to diminish. High, high, can't take out the highs, and then falling out of bed. This is what good trading is. Listening to the tone of the market. Following a plan. Having a methodology. And then the other thing also is the mindset. To have this trading psychology, this trader's mindset that, again, you don't have fear. You know what you're doing at all times, and you're following your plan. What's the difference if you open a business? Are you going to have fear if you open a restaurant and then people didn't come and you already purchased food for dinner for them? Probably not. You wouldn't be happy. But you know what you should be doing. You know that you got to cook the food once the orders come in, and basically you're trying to run a business. Trading is a business. This is not entertainment. This is not gambling. And again, I've been doing this for 18 years. I've been compounding money. And this is what it really all boils down to. Having the plan, compounding money. We spoke about that on our last lecture. In the last lecture, we talked about how the power of compounding, you can compound your way to wealth, or as we said in this webinar, how we call it, where fortunes are made. The fortunes are made, but it's not a get-rich-quick. It's to compound your way to wealth over very long periods of time. And trading a plan. Let me jump to you and see if there's any questions. I have to figure out how to open up so I can see the questions. 1 second, please. Let's see. Attendees can ask questions. Let's see. Is there any questions at this point? If you can put your hands up of any questions. I'm not exactly sure how I can see the questions. That's a problem. Because I was moving things around and I can't see. It was a bar that shows questions. and I lost it actually. Okay. If there's no questions, let me just reiterate this way. One more thing I just want to say. If you want to contact me, you can contact me at andrew@trendfollowingmentor.com. Best is to email me. I leave my phone on for voicemail because when I trade, I really don't pick up the phone, and I call afterwards. Again, I have a book coming out called The Bible of Trend Following, which I invite you to pick up. And again, this is in a series of webinars with ForexP. And if there's anything I can help you with or teach you, I'm more than available to help you and direct you. I also have a free 40-page ebook on trend following. You can email me. And again, I invite you to participate and ask me any questions that you can. Thank you very much for coming, and thank you. Oh, Wanda has a question, I think. 1 second, I'm trying to figure out how to get to the question. Wanda? Can't see your question. Send questions, send... 1 second, Wanda, I'm trying to figure out how to do this. And I don't now, because I lost the thing for questions. Tell you what, you can email me. Here's my email, and then I'll get right back to you. Here's my email, and then if you have questions, you can email me, and then more than happy to help all of you. Again, thank you very much, and any questions, just let me know. Thank you.